8.
Hello everybody and welcome to this special webinar event. I'm Ryder, the Managing Director and Founder of hotspotting.com.au, and today we're talking about one of the most important but least understood topics in property investment, the role played by depreciation. Our headline has said that depreciation is more important now than ever before, and here's why. The 2017 federal budget changed the game, and the upcoming federal election may change it even further. If Labor wins and implements its negative gearing policies, the deductions available through depreciation will be crucial to the bottom line of property investors. Now, I'm not an expert on these matters, but fortunately our guest presenter today is Tyron Hyde, is the CEO of Washington Brown, Australia's leading expert on property depreciation. He's also a best-selling author. He's written the definitive guide on these matters, a book titled Claim It, and he's also written a sequel which is called Keep Claiming It. You're about to meet Tyron, who has the rare ability of making this topic sexy and interesting. Before I introduce him, be aware that you can ask questions by typing your queries into either the chat box or the Q&A panel that you should see on the screen in front of you, and we'll answer your questions towards the end of the presentation. So Tyron Hyde, welcome. Not only are you the best-selling author of a couple of books of your own, but I think I saw your picture on the cover of someone else's book this week recently.
Dale Beaumont's Secrets of Property Millionaires, and it's a funny story that when there's 12 authors in there, and about 10 years ago when he first published Secrets of Property Millionaires, I was walking through the airport and I knew half the people in the book, and I said, I should be in that book. Lo and behold, 10 years later, there I am on the cover. So that was a bit of a goal dream come true, which is great. And you mentioned Claim It and Keep Claiming It. The actual title, Keep Claiming It, came from a webinar. What I did when the laws changed, I'm about to talk about, I had a poll and I asked people on a webinar, if you came up with a book title or suggested a book title for my new book, you'd get a book for free. And someone said, keep claiming it. And I like that. So that's what happened on a webinar one time. But we're here to talk about what's changed in terms of depreciation. And lots have changed over the last 2 years in terms of what you can claim. The 2017 budget changed the game for property investors. And I'll tell you how that happens very shortly. So why is that not moving? We just did that and now it's not moving, Terry. Wait a second. Here we go. So why I'm here, so my name is Tyron Hyde, as Terry said. I'm the CEO of Washington Brown. We're quantity surveyors. And what quantity surveyors do is we work out what things cost to build. The reason that I'm here today is because in 1997, there was a tax ruling called TR 97-25, which identified quantity surveyors as being the experts to estimate construction costs where the costs are unknown. And the reason that's important is because you as a property investor, you need to know the original construction cost of the building in order for you to claim the depreciation of the structure. And if it's second-hand, not many people know what it actually costs. So you can come to someone like Washington Brown and get an estimate from us. Now, so what's changed? There's been a massive change in my industry. I've been doing depreciation schedules for nearly 50, and I started when I was about 23, so over 25 years. What's changed is you can no longer, in the good old days, what we used to do is we'd go out to every property, regardless of the age, and we would value the plant and equipment in the property. So we would put, even if the property was 50 years old, we'd say, as part of that purchase price, you've acquired that oven for $1,000. And you could claim based upon what we estimated that oven to be. So that's the plant and equipment in the building. There's two parts of a building report or a depreciation schedule. There's a plant and equipment, the division 40, which is the ovens, dishwashers, all that stuff that wears and tears quicker. There's also the structure of the building, the division 43. And in order to claim the structure, like the bricks, concrete, windows, as you see in this picture, the building has to be built after 1987. So what's changed? The government, you can no longer, as a property investor, claim the depreciation on any plant and equipment item that's second-hand. So to put that in perspective, you buy a 1-year-old apartment today, you can no longer claim the depreciation of the oven, of the carpet. You still claim the building, but not the depreciation of the carpet, which is kind of bizarre because the government also says that the carpet's going to last for 10 years. But if you buy it after a 1-year-old property, as I say, you can no longer claim. This is straight from the Treasury announcement. They are going to deny income tax deductions for the decline in value of previously used depreciating assets. The main bit there is the previously used. So even if it's 1 day old, if I buy an apartment from you or from anyone that's 1 month old, I can't claim the carpet or the oven or those items anymore. And why do they do this? Because this is an integrity measure to address concerns that some plant and equipment items are being depreciated by successive investors in excess of their actual value. And they had a point, to be honest. There was a bit of a loophole, and we would, in the way that we would value the plant and equipment items, we would go to properties that are 50 years old and still say, well, you just paid $500 for that oven, because that was in the purchase price. There was no breakdown of exactly what it is. So I think it needed to be addressed. I think it could have just been addressed a lot better. So when these changes came around, we surveyed it. We were getting inundated with questions by clients, and I made all my staff write down all the questions that we were getting. And I came up with the top 14 questions. Number one, how does this factor into new property? Well, the good news is it doesn't. So if you buy a brand new property, you can still claim depreciation exactly as you could before the budget announcement. The government do not want to halt construction. There's a lot of after-flow effects when people build. Even your Harvey Normans and buying furniture, etc. So they didn't want to stop construction. So you could still buy a brand new property and claim depreciation exactly as you could before. Number two, how does this affect offices, industrial? We do many varied reports, whether it be funeral parlours or you name it. We have done many different types of buildings. And provided that it's not residential, there's no change, which is kind of bizarre. So the government's saying in one way that the system is broken for second-hand residential property, but it's okay for second-hand offices and industrial properties. I find that a little bit bizarre. Number three, can you still claim the bricks, etc.? Yes, so there's no changes, as I said, to the construction costs. So that's good because the construction of the structure, the construction cost of the structure represents about 85% of the cost. So we're only talking about that 15% plant equipment items, ovens and dishwashers, that has been affected. So what happens if, number four, can I claim owner inclusions? What if you go and buy a brand new oven now? How does that work? Well, yes, you can, provided it's brand new and there's GST payable on it. But if you buy something off Gumtree, you buy an oven off Gumtree that's 1 year old, you cannot claim it. It has to be brand new. Number five, entity changes. So if you buy a property in a company name, you can still claim depreciation exactly as you could before. It's kind of bizarre. In a super fund, there was no change, but not SMF super fund. It has to be a large super fund like Resi Super or one of those Host Plus, whatever. They could go and buy 100 apartments and claim second-hand apartments and claim depreciation, but you or I can't walk down the road in Waterloo or buy one single apartment. Again, pretty bizarre. And large trusts, provided you've got a trust, if you've got a trust that has 300 members, they can still claim depreciation on second-hand properties, but you or I can't. So Macquarie Bank could put a residential fund together of second-hand properties and go and claim depreciation, but we can't buy a second-hand property. Is it grandfathered? So what happens if you own it? This is one of the biggest questions. What about I already own a property? How does that work? Well, there was no changes provided you own the property before the May budget in 2017. But I used to say yes, it's grandfathered, but now I put there yes and no. And the reason I put yes and no is you can still claim depreciation on a second-hand property provided that it's an investment property the whole time. If you move back into it for a year, if you move into your investment property for a year, then move out and rent it out again, you now lose the deductions. So it has to be an investment property the whole time. What if you inherit a property? Well, similar to what I just said then, it's exactly like buying a second-hand property. It's already been used. So when you inherit a property, the property's been used before, you can still claim the building allowance, just not the plant equipment. And as Terry said, if anyone's got any questions, please fire away, and I'll answer them during the talk. New apartments. Well, what happens if you're a developer and you're selling an apartment that sometimes developers, especially now, they will try and put a tenant in and sell it with a tenant in there, does that become used? Well, the government has said it's a 6-month rule. So a developer can sell a brand new apartment up to 6 months after completion with a tenant in there, and it will still be able to be claimed depreciation on it. That was an afterthought by the government because they didn't even think about how that would work. What happens if you buy overseas property? Most people don't know that you can claim depreciation on a property overseas, exactly like you can here. And I own property overseas. The only difference between buying a property in Australia compared to overseas is that the date of construction has to be after 1990, not 1987. Don't ask me why, but that's just the law. What if you renovate? Okay, so if you renovate, you know the construction costs. It's all brand new. You can claim the depreciation on that property even after the budget announcement. So it's like it's brand new. So you can still claim depreciation on renovations. What happens when you replace an item within a property? Well, this is where it gets a little bit confusing. If you were, say you bought a property that's 5 years old, you can't claim the depreciation on it, but you did pay for that oven, right? So how does that get treated? Well, we put values onto those items, and when you remove it, you get a capital loss. That capital loss can be not offset against your income, but it can be offset against a capital gain when you sell the property, or it can be offset against other capital gains, maybe from shares, provided it's in the same entity. Show me the numbers. So what does this all mean, Tyron? Okay, so let me just move my slide up if I can. There we go. Okay, so I'm going to compare 3 different types of properties now. Let's say you buy a brand new unit for $850,000. Pre-budget, you would have got $20,000 in year 1, 17 in year 2, down to 135 over the first 10 years. After the budget, it's exactly the same because it's brand new. As I said, brand new properties haven't been affected by these changes. Now let's compare something that was built, say, in the year 2000, 850K purchase price. Prior to the budget, you might have got 15,000 year 1, 13, etc. year 2. After the budget, the same property, you'll only get $6,000 in year 1, 6,000 in year 2, and that 6,000 is fixed because that's the construction cost of the structure. That's all you get. That's all you get to claim now. So the difference there in year 1 is that about $9,000, and that's the depreciation of the plant and equipment that you can no longer claim. So towards about year 8. Looking at that, it's pretty similar. It's just that in the first years, you are getting a lot less deductions in depreciation because you're not claiming the plant and equipment. And why that's important is because as a property investor, you tend to need those deductions up front because that's when it's costing the most to own the property. And as time moves on, your rent goes up, so they kind of come counterbalanced. But now it's a big difference. And what this does, if you ask me, is it creates a bit of a 2-tiered market in property. So something now that is 1 year old, and I've read an article on this from a financial columnist in the Sydney Morning Herald, and he was arguing that a second-hand property now that's 1 year old has an equivalent of a $50,000 difference in purchase price, in value immediately because of this. And I kind of agree with him. It does create a 2-tier market. Why would you buy something that's 1 year old and get that's very exactly the same or very similar to something could be even in the same development? And the one on the brand new one, you're going to get $20,000 deduction. The second-hand one that's 1 year old, which looks exactly the same, you're probably going to get the same rent, but you're going to get $6,000 in deductions. So it does create a bit of a 2-tiered market. And that will also occur even more so if negative gearing is abolished on second-hand properties. So what about if you buy a property that was built before 1987? And the reason I say that is because that's when the age of the property has to be built in order for you to claim the structure of the building. Well, prior to the budget, you'd get about 6,000 year 1. Now you get 0. So if you buy a property built before 1987 that hasn't been renovated, you will no longer get any depreciation on the structure or the building. So that's a big difference. So in the column there on the left, the 6,000, that was really just the depreciation on the plant equipment. There's no building allowance because it was built before 1986. It's a pretty rare scenario that this occurs because something that was built in 1970 probably has had a renovation by now. So we still do lots and lots of properties where the original structure was built before 1987. So how does this work this is a pretty interesting graph here of a guide, or what would you call that, table, of the difference between buying a brand new property, probably aged between 87 and 2016, and something probably built before 1987. So I've analysed, factoring in the depreciation allowances, I've analysed what the net effect to you as an investor will cost you to own that property. So let's look at brand new property first. So I've assumed the rent on each property here is exactly the same for each one. So you're going to get $700 a week in rent for the brand new property, the middle-aged property, and the older property. I've assumed interest at 5.5%, which is probably at the upper end, obviously, in this day and age. But I've assumed you've borrowed 80% for each one. So that's all the same. So you're getting rent the same, the interest costs are the same, the levies are going to, I've assumed the levies are all the same. So for each property here at this point in time, it's going to cost you, physically cost you $7,850 to own each property. Now, this is where depreciation kicks in. On the brand new property, you get another $15,000. So that $7,850 is a loss, which will be tax deductible. You now move into the depreciation on each one. This is where it gets different. So the brand new property, you'll get a $15,000 deduction. On the middle-aged property, you get a $4,000 deduction. And the property built before 87, you get zero. So what does that mean? Well, you add up the losses. You add up the non-cash deduction loss of the depreciation plus the loss from the expenses and interest. So the total loss for a brand new property is high. It's high because you get the massive depreciation. So it's 22 grand is a loss. The older one, the middle-aged one, is 11 because it's 4 plus 7, 8, 50. And the older property, you don't get any depreciation, but you've still got the loss from the interest cost. So the total tax loss there, as I said, 22, 11, and 7, 8. So if you get a tax refund, say you're on the tax scale at 37%, if you put a $22,000 loss in, you get $8,455 back. That then offsets your actual outlay of 7,850. So it actually pays you, the brand new probably pays you $12 a week to own. Compared to the old property, because there's no depreciation, it's going to cost you $100 a week to own. It's a big difference. So it does create a bit of a two-tiered market, if you ask me. So what should they have done? Stop complaining, Tyron. What should they have done? Well, the tax office, the Treasury Department, asked me to come in and because I know a little bit about this, and I wrote a book, as Terry said. So they asked me to come in and give them my thoughts on this proposed change. And I was a little bit surprised by this announcement, and I think I really didn't trust what level of detail they'd gone into this. And part of the reason was because this is actually from the Treasury notes or the information memorandum about this. And I thought, well, you don't. Okay, so what they said from the Treasury, they said that at the same time they've disallowed you able to be claiming the travel deductions on an interstate property. And that made a bit of sense. But look at the numbers they said in their revenue. They said that this year it was going to save the budget $160 million. And they said that by limiting depreciation on second-hand properties, it's only going to save them $40 million. So they think that there's 4 times the savings in disallowing people flying from Sydney to Gold Coast to inspect their property than all of Australia claiming second-hand depreciation deductions. So if that's what they're basing on, do a bit of maths. We alone as a firm would save clients that much money per annum. So I thought it was a bit rubbery what they've done. So what should they have done? Well, if you ask me, as I said, I do think there was an issue in the way that we could still, as investors, claim depreciation on items that were 50 years old. However, I don't think making it that even if it's 1 month old, making it so that there was zero claim was a smart thing to do. So it was quite simple. What they should have done is, let's say you bought a property that's 5 years old, and within that property there was carpet when it was brand new at $3 grand. If you sold it after 5 years, or I bought the property, the value should have been $1,500 because the carpet has a 10-year effective life. It should have just cut at the 5-year mark, and I should then, as an investor, be able to claim the residual $1,500. If I bought that property where it was 12 years old, from when it was brand newly constructed, it should have been zero. So we as quantity surveyors can quickly find out how old the property is. We know, because we inspect properties all day, every day, we know if it's brand new carpet or if it's existing carpet, and we could put a value and say it's zero, or it's 7 years old. You've still got $300 left to claim, etc. So that's what I think they should have done. That wouldn't have created this massive two-tier property market, in my view. But they asked me, they said, that's a great idea, Tyron. They asked me, put a submission in, and I did, of course. It took me about 2 weeks to write it. I was pretty proud of it, and of course, it wasn't adhered to. They were just playing the game. How can you learn more? Well, I did write a book called Keep Claiming, as Terry mentioned. I'm going to give you a special offer at the end in order to get this book, but it's not just about depreciation. It's about property investing in general. My story on what I've achieved and from knowing so many investors in my life, some of the richest men in Australia, I've learned a lot about property, and a lot of stories are in this book. So hopefully you might want to get a copy at the end. So how do you crack the code? So when these laws came in, I thought, well, what could investors do, or think outside the box in terms of claiming these deductions? I came up with 7 ways to manoeuvre around these new laws. So the first way is, quite simple, you buy brand new property. You can still claim depreciation on brand new property. I know some people say it's not, don't advise people to do, but brand new property can still make you money. I've bought brand new property, I've bought second-hand properties. It's just timing of the market, if you ask me, as to where it is. And Terry could obviously help you there and advise you at what point in the cycle we are at in certain cities. But brand new property can also be buying a hostel or commercial property. It doesn't have to be residential. Number 2, the corporate rate. This is a strategy. The corporate rate strategy. So as I said, you can still buy a property in a company name, which I did recently, and still claim the depreciation on second-hand property. Now, I know every accountant will say, oh, you don't do that, you don't get the capital gains tax discount. True, but that's becoming less and less because the company tax rates are coming down. You can still claim the depreciation on it. I bought a property in the UK, and because companies you can still travel to the property as a tax deduction overseas if it's in a company name. You can also, if the property is cash flow positive, you can also income split or have your wife as or your partner have it as employee, and that way, if it's cash flow positive, you could possibly split some of the income that way. So that's just something you could do. I'm not a financial advisor, so please seek your own advice, but I personally have done that. So the big boy, big girl strategy. Well, you can buy a company, a office or an industrial property. Play with the big boys, and that still is claimable. So these new laws only apply, as I said, to residential property. You could get a Washington Brown. When these laws came about, we had to have a big think about what we're going to do, and we've now split our reports into 2 components. We issue what's called a Washington Brown CGT saver, and we still go out to the property and we value all the items that you've bought. You can't claim that except when you sell the property or when you remove the item. So you can still have that capital loss quantified throughout the process. The CGT saver. The other thing you can do, what we do now, is we split our construction costs more than anyone else in the market. One of the things that's bugged me for a long time is that as property investors, when we issue a report, we gave you the whole construction cost. So it might be 200 grand, and we would not break that down. What we do now is we itemise the things that we think are going to wear and tear quicker. So the government has said that things like showers, screens, kitchen cupboards, wardrobes, all these items are going to last for 40 years. And I don't agree with that. From our experience, a lot of people replace the kitchen cupboards after about 10 to 15. And as an investor, if you remove those items and there's 25 years left of costs to go, you can write off the balance of that cost. But if you don't know what the kitchen cost is, all a quantity today has done is give you the overall cost. How do you know what the balance of the kitchen is? So what we do now is we itemise the things that we think are going to wear and tear quicker or not going to last for 40 years. And that's can be a huge deduction for a property investor. The big, this is the boohoo strategy. What I said was, next time your millennial comes home and says, I can't afford to get a property. Well, what you can do now is you could buy brand new property. If it's under 600K, this is like an example I did for Melbourne. Under 600K, you have no stamp duty payable. You get a first home buyer's grant. In Melbourne, it was 10K. So they pay you 10K, no stamp duty. And if regional, it's 20K. Now, if you render that out straight away, you could claim the depreciation and then move in. And then move in, say, on the 11th month, and you live there for 6 months. So you've got brand new property, you've got no stamp duty. Might be a house in regional Melbourne. Regional Victoria. No stamp duty, payable under 600K. $20,000 in the hand. You get another 15K depreciation on that property, and then move back out. So I don't know about you, Terry, but I didn't certainly have that the benefit of that kind of allowances when I bought my first property. So
that's such a long time ago, Tyron, I can't remember, but no, I don't think so.
You're saying that I'm old or you're old?
I'm saying I'm old.
The final strategy is what I think is my favourite one. And as I said, in this day and age, the things that have come into effect or that aren't being able to claim are items that last about 10 years. So the carpet, the oven, dishwashers, blinds. And so what you could do is you buy a property that, say, is 8 to 12 years old. And why I like that is because you can get, it's a lot easier to find the real value of a property rather than what a developer puts on it by looking at things like RP data or CoreLogic as they are now are. I could look at all the sales, second-hand sales in a block of buildings, say. So I buy a property that's 8 to 12 years old. Now, when I remove those items, I want to do a quick small renovation of 20 grand. I remove the oven, I remove the dishwasher, I remove the blinds and carpets. What value was attached to those items at that time, I can claim a capital loss on those items. I then do a small renovation of 20 grand, put in new carpets, ovens, dishwashers. I can claim the depreciation on those items because they're brand new. Because the property is 10 years old, say, I've still got 30 years left on the structure of the building, right? So I'm now getting a brand new depreciation on the ovens and dishwashers. I'm getting a capital loss on the things I've moved. I'm getting the same building allowance as I would roughly on a brand new property. So I'm actually getting more tax deductions by doing this compared to buying just, a property that's 20 years old. So I really like that strategy. So who wants some great news? The great news is I've still got a job. Because you still need a quantity surveyor to estimate the construction costs where the costs are unknown. So you still need us to go out there and value what it costs, the original construction cost. So when I did this webinar first, I thought, what are these changes going to make? If I look at the future, what's going to happen to the property market? And I think I was a little bit right. I think developers are going to target investors that they always have, but they can now quite rightly say, hey, come buy my brand new property because you get greater tax deductions on a brand new property compared to a second-hand property. This is going to be even more prevalent if Labor abolishes negative gearing to second-hand property investors. It's going to be a huge, huge boom for developers, which is not necessarily a good thing. Some ways it is, but some ways not. I think people might start thinking about buying a property in a company name to get these deductions and travel allowances. I have, but I know not many accountants would tend to agree with me, but I think one thing I've learned over life is to think outside the box when investing, and that's a bit out there. I think there'll be confusion. I still think there's confusion. I still don't think a lot of investors know what the impact of these changes are. They certainly were at the beginning. Slowly, it's becoming knowledgeable, but it is. I don't think many people understand the true financial impacts of these changes. I think what we're going to find, and I think it's already happening, is that there's going to be a lot of people who bought off the plan, who now want to sell, or who have paid more than possibly they should have, who now want to sell into the second-hand market, something that's 1 or 2 years old, and it's going to be a struggle because, as I said, the difference in deductions for that second-hand property compared to the brand new one next door is great. So it's not wouldn't be a great time to be selling a second-hand apartment where it's 1 or 2 years old in an area where there's a massive amount of construction still going on. It would be tough if you ask me. So I did write a book, claim it, bestseller, 7,000. In order to put that bestseller logo on my book, I had to sell 7,000 copies. The fact that my mother bought 5,000 of them is completely irrelevant. It still counts. That was a joke, Terry.
Very good.
There's some stories in the book. This is when I was with Harry Truboff. I actually wrote a chapter in the book called High Rise Harry. I'm actually here. I'm staying at the Star Casino because I actually went to his 86th birthday last night. I don't know if you're not from Sydney. He owns Meriton. He's worth about $10 billion last count. He's built I think 75,000 apartments, and so I went to his birthday last night. He's a funny man. Anyway, so when I wrote the book, I took it on tour with me. And I got a lot of photos at interesting places. But the real thing, what I wanted to do was write a blog. Once upon a time, there was like a fairy tale. Once upon a time, there was a princess, and she lived happily ever after. But I took the book to Disneyland, and there's this lady that I can't remember which fairy she is or the princess she is, but she's like, "No, you can't take a photo with that." There's my daughter. And then what happened was after that, you go around to the next booth, and security had come, 6 security guards had come and stopped me putting the book next to the princess because you cannot monetize a Disney princess. I'm like, it's a book about tax depreciation law in Australia. Come on, I'm not gonna make any money on it. So there's me with a book behind my back, and they told me to put that book down, sir. So takeaways. As I said, the rules have changed. If you bought a property prior to the budget, there's no change for you. So now is the best time to get a depreciation law because who knows what's going to happen in the future. You can still claim the building allowance regardless of any law change. So if it's built after 1987, you can still claim the structure of the building. Commercial, industrial properties, anything that's not residential has not changed at all. And as I said, there's 7 ways to crack these new laws, which are in my book as well. So here's I got a deal for you all. So also, as I said, Terry, the secrets of property millionaires. So I'm going, if anyone emails me after this, which I'll put my email address on the next slide, for $20, I'm going to give you a bargain because each book's worth $29.95 each. I'm going to send you with a copy of each book signed. I don't know whether my signature adds values or decreases the value of the book, but I'll get it signed. Now you're laughing, good Terry. I'll get it signed and sent to you, which basically covers my postage, but it's a thank you from me for you attending and staying on the webinar. So if you have any questions, please fire away. Don't know what that 50 is for, but so you can email me at tyron@washingtonbrown.com.au. So if you want to write that down, just flick me an email and I'll with your address. And I'll send you a link to how to pay for it, and I'll send you out a couple of those books, which is a good deal. So
thanks for that, Tyron. So just reminding everybody, if you can just type in your questions in either the chat panel or the Q&A panel. There's a few there already, and I'll relay those questions to Tyron. So please feel free to bang in your questions. Tyron, I've got a question, and I remember when the 2017 budget came out.
Yep.
And they announced there are going to be changes to depreciation, but it was really, really unclear. I don't think they'd thought it through terribly well.
Totally.
And there was a lot of uncertainty created by that. Well, nobody was really too clear on what it all meant. Do we now understand all the repercussions? No, we're now almost 2 years later, I guess.
Yeah. Look, it's pretty clear now. You're right. When it first came out, it was like 2 lines in the budget announcement, and there's a lot of implications that needed to be worked through in terms of this. At first, we didn't know whether we didn't even know whether it was new property or old property. It just said properties. But you've got some interesting cases, right? I'll give you an example. let's say you bought a property in, I say, I don't know, Oxford Street in Paddington. Downstairs you've got, and it's on one title. Downstairs you've got a retail strip, and upstairs you've got residential. You've got a residential apartment. Now, you can claim all the depreciation on everything that's within that, even though they're on one title. You can claim all the depreciation on everything that's in the commercial or the retail strip, but what's in the residential, you can't. You can only claim the building allowance. But let's say you've got ducted air conditioning that goes through both systems. You've got one controller that controls both. How do we split that? So there's many things like that that are not that simple. And it's similar, I think, with the negative gearing policy at the moment. There's going to be many things that have to be worked through if that does get enacted. Whether that depends on whether they win. I think on negative gearing, I know we're going to go there. I'm writing an article at the moment saying that I think, which might surprise some of you, that I think it does need to be changed. I think there's a little bit. I don't ever think the negative gearing laws were meant to entitle people to be able to claim depreciation on 50, negative gearing on 50 properties, or that you could buy a house in Vaucluse for 20 million, get 3,000 rand, and have a massive loss in that regard. It's just, but how that then manifests itself, or what you will be able to claim, is I have a different strategy for the government, which I'm writing the article for, which I won't let go now, but it'll be in my article on that.
Okay, so Tyron, Sean is asking the question: is it proposed that if Labor wins the federal election, they're going to eliminate negative gearing? So they say on second-hand properties. Have they said anything about getting rid of depreciation on second-hand properties, or will it be the case that you can't negatively gear it, but you can still claim the depreciation that's currently available?
It's a great question, and that's, again, is a little bit of unknown what exactly their policy is. So my issue is I don't think people really understand that what negative gearing is. And if you actually look, so what they're proposing is that you won't be able to claim the loss on the property, but within that loss are things like property management fees, accounting fees, land tax. So you won't even be able to claim, if your property is running at a loss, it includes things like depreciation, obviously, and land tax. So you can't even claim the tax that you're paying on, because that's part of the overall negative gearing loss. And that's one of the arguments that I'm going to make, is what it should be. It should possibly look at, firstly, having some marketing about what actually negative gearing is. I think if you ask the average person on the street, who say, I don't know, 50% of people say that negative gearing should be abolished. If you ask them, what does that actually include in negative gearing? And I said, did you know that it might be that you can't now claim property management fees? That person that wants to abolish negative gearing would probably go, oh no, you should be able to claim that, right? It's like saying on stocks, you can't claim your stockbroking fees. So I think there is a lot of confusion about what negative gearing is, and I think either side should actually kind of have a marketing department on explaining. Well, it actually means that you might not be able to claim property management fees. You might not be able to claim the land tax that you're paying on the property. And I think the average person on the street would go, well, that doesn't seem fair. But that's what could happen.
So another question, Tyron, that's come in. If I buy a house as an owner-occupier prior to 2017,
yep,
and then in 2019 I move out and convert it to an investment property,
yep,
how do the new rules apply to that?
It's a very common question, a very common problem, I guess. So if you bought the property, say it's brand new, and you lived in it, and as an owner-occupier initially, you cannot claim anything because it's owner-occupied. The moment you move out, because those items, those plant equipment items now are previously used, you can't claim the depreciation of the oven and the dishwashers anymore. You can still claim the structure of the building, which is 85% of the deductions that are available, but you can't claim the oven and dishwasher that might only be 2 years old because they're previously used. So that's a big change to what it used to be. We used to go out and say, okay, well, when it was brand new, the oven was $1,000, but you've lived in it for 2 years, so there's only, say, $800 left to go, and you start at the $800. Now you start at zero on those plant equipment items.
Okay. When you asked the question, just clarifying about the travel deductions, they disallowed claiming your travel expenses if you wanted to go and look at your rental property. Is that any travel at all, or just interstate travel? What's the situation there?
Okay, so I'm not an accountant. It's not my really expertise, but from my understanding, it's anywhere travel. It's any travel. So you're allowed, unless you're a company that specialises, say you run, aged healthcare, that kind of company can go and inspect their properties, but you as an investor cannot, a residential investor, say a PAYG earner, you can't go to your property, whether it be regional or interstate or overseas, and claim the travel costs anymore. But please check with your accountant.
Okay. Could you just explain a little bit more about the sort of pros and cons of sidestepping the new rules by buying a property in a company name? I mean, it sounds like an interesting strategy, something that some people do anyway, for various reasons. But it's one that you mentioned, I think, in your seven ways to maximise what's available. That was one of them.
That was one of them. And as I said, I've done that recently. So I own properties in super fund, trust, company, and for various reasons, that's how that's occurred. But the company one it's just you buy it in a company name. Now, most accountants will say don't do that because you don't get the CGT deductions when you sell the property. But I have no intention of selling the property, so I don't care. So I'm still getting the depreciation. I'm still able to travel to the properties in the UK. And it's cash flow positive. I didn't borrow, so it's all cash flow positive. So it just, it's and the depreciation helps that, because obviously otherwise I have to declare that income. So so it's pretty simple. You just have to buy in a company name. But whether your accountant would recommend that, it just depends on your circumstance. So as I said, I don't have any intention of selling it, so I don't care about the capital gains tax benefit. So, which is going to, again, that's another part of Label's proposal. They're going to limit that as well. So there's maybe, again, that might become more relevant, because at the moment you get the 50% CGT discount if you've held the property in your personal name for more than a year. Under Label's proposal, it's not just about negative gearing. They're also going to limit that to 25%. So again, with that argument of not buying a property in a company name, all these things are pointing towards it not being as relevant as it used to be.
Okay. You mentioned the CGT saver strategy. I just thought it might be useful to just explain that in a bit more detail.
Sure.
Sounds like another interesting one.
Well, so as I said, now when you buy a property that might be 1 year old, see on your purchase price of the contract, it might say, the property is 700K. What it doesn't do is break down all the items that you've acquired. You've bought $700,000 for land, for building, and for assets within that property, right? But it doesn't. The contract in commercial, it does. It will separate those items and say, as part of that contract value, this is exactly what you paid for the aircon, what you paid for the carpet. But in residential, I don't think I've ever seen that. So what we do is we separate the building out and the plant equipment items and the land. And whilst you can no longer claim the oven and dishwasher value if it's more than 1 day old now, if you remove those items, you can claim the capital loss, because you have paid for that oven. You just can't claim the depreciation on it. So we give you a report that says, here's all the things within your property. The value at the time of purchase was X, Y, Z. And so if you remove it, you get to claim the loss, which can offset the property value of the the property sale price in the future. Or immediately, if you remove it, you can, if you've made other profits in the shares or other profits in other properties that you own, you can claim, you can offset that profit with the capital loss items that you've just removed. Does that make sense, sorry?
Yep. Okay. Now, you also mentioned there's different situation for an individual compared to a company. We touched on that. A super fund, but not a self-managed super fund. You also mentioned a trust, but I think you said that it applies only to a large trust.
Large trust. You have to have at least 300 members in order for that trust to, which, not many people have trust with 300 members in it. But so in essence, as I said, a Macquarie Bank, for instance, could still buy 100 one-year-old properties, put it in a trust, and still claim the depreciation as they do as prior to the budget. But you or I can't, in our own name, go and buy a one-year-old apartment and claim the depreciation.
Yeah. So
which seems a little bit funny to me.
Yeah. So the ordinary family trust.
Is in the loop. You won't be able to claim. Same with the ordinary self-managed super fund. It's only the big players that have been exempt from this.
Okay. So a question that's coming: if you're renovating an investment property, is it worth spending more on the fixtures and fittings and buying them new so you can maximise the depreciation?
It's a good question. I tend to say it really depends on what on the property that you've acquired and what the market value is. You wouldn't, if you bought a property in Penrith or somewhere, you're not going to go and spend $5,000 on a dishwasher to get the depreciation. You've still got to buy the best value item for that property and the market that it's within. However, I would say that you'd be better off buying something that's brand new where you have a receipt, say for $1,000, as opposed to getting something off Gumtree for $800. Because of the $800 item, you're not going to be able to claim it all, but the $1,000 that you bought from Harvey Norman brand new, you will be able to get $1,000 deductions over the next 10 years. So that's how I'd answer that question.
Okay. You mentioned that you were asked to provide a bit of a critique by the taxation office.
Treasury Department,
yeah. You put a lot of time and effort into it, but is there any evidence that they listened and there's going to make any difference, or was it just a PR exercise? It
was a PR exercise. Look, to be honest, I was pretty honoured to be asked in to give my opinion, and it was the 4 people in the room. One of them wrote the information memorandum and the legislation on it. So they were incredibly impressive and knowledgeable about. Like, I know one part of I know this much of the Tax Act, and I know it off by heart. But they were incredibly knowledgeable in their knowledge of what we do, and I was pretty impressed. And I think that they weren't allowed to say, but they were kind of nodding. I think they agreed with what I was saying. It made a lot more sense, but they had to go through the processes and they had to appear that they've had industry consultation, right?
Right.
But it was already written. It wasn't going to change. The only thing that changed from the initial draft legislation to the final was the developer's 6-month rule, where they can still sell a unit that has been let out. And I think that occurred because the property councils, who's pretty powerful, addressed that. But the property council looks after the developers. So they addressed that. I think the developers had concerns with that, and so that was the only change from the initial draft legislation to the final legislation.
Right. Just a general question about the awareness of people out there to the potential for their bottom line of depreciation. Is it still the case that a lot of people out there own investment properties and they're not claiming depreciation, or they're not maximising?
I know a lot of companies portray that as marketing, but if you ask me, in this day and age, well, compared to when I started, Terry, 25 years ago, the amount of people that claim depreciation compared to back then is phenomenal. So I think if you're buying investment property now and you don't know about depreciation, well, you're not really getting that good advice, to be honest. But that said, we still get people come to us 5 years after they bought a property, but it is a lot less than it used to be. And they come to us 5 years after they bought the property and say, and it always occurs when they've changed accountant. They go to a new accountant, and the new accountant looks at the books and says, why aren't you doing that? And then they come to us and we backdate the reports back to 5 years ago. Whether they can go back 5 years and amend their returns is between them and their accountant, but we backdate the reports to when they settle on that property. But I think it is a lot less than it used to be, for sure.
Okay, so the average property investor, they buy a property, they get a depreciation schedule done by Washington Brown. what's the effective life of that report? How often do you need to renew? What circumstances would dictate when you need to go back to Washington Brown and say, we need this report updated or replaced?
I'd like to say that you should come back to us every year and be charged a fee, but I can't. The effective life is really 40 years. So we give a report that lasts for 40 years if it's brand new. However, if the property is 20 years old, in reality, the effective life, as you said, of the report is only 20 years because that's the amount that's left on the building allowance component. When you come back to us, good question. So if you do a major renovation of the property, if you've done something, say, over 30 to 50 grand, I would say it'd be worth coming back to us and updating it. And we may be able to say, well, okay, you've removed a wall. There was a value left in that wall that's now removed. You can get that as an immediate write-off. However, if you just buy an oven or dishwasher into your property, probably not worth engaging us to update the report. Just give those costs to your accountant. But anything over 25 grand, probably worth having a chat.
Yeah. Okay. So major changes to the property, which could change the depreciation claims in your favour. It's quite good, and you can get the existing report updated.
Correct. Yep.
Yeah. Okay.
And if it's small, we don't charge anyway. So if it's small, if it's 20, we don't charge. But if it's something like 200 grand, where we may have to go out and re-inspect the property, then we start charging. But for clients that have just spent 20 grand and they give us the costs, we don't charge. We just update it.
Okay. Could you just, we're sort of getting towards the end of the hour, could you just reiterate the special offer? There's more than one book involved there, isn't it? It's your most recent book on Keep Claiming It.
Yep, which I wrote after
the new book that features your a picture obviously taken about 20 years ago of yourself there.
Thank you, Terry.
Called Secrets of Property. So you get both.
Photoshop's a wonderful thing.
Yes, exactly.
I said, put more hair on me.
Hair's very overrated, Tyron. But
so they email me that email, and with their address, I'll send them a link to where they can pay for $20, and I'll send both books out, signed. The good thing about they're both good. Well, I've got to say that, but they're both good books. The Property Millionaires one is 12 chapters, individually written by property experts. On the Rich Harvey, you probably know. Colin Frager's an interesting one. He's a planner. He's a land surveyor planner. He's pretty interesting. So there's what's his name's in it? Ian Ugarte, who you know. I know you know. So it's a good read. And as I said, so the guy that does that book, Dale Beaumont, he comes up with a series of secrets of entrepreneurs exposed, secrets of share traders exposed, and he gets industry experts to help him write the book. It's pretty good.
Okay. Okay. So
I'll put my email up again.
Right. So it looks like some more questions have popped up. Kieran's asking, it sounds like that with the proposed negative gearing and depreciation changes, the resale value of an existing investment property will decline. I think you referred to that when you're talking about a two-tiered market that's been created by these situations.
Yep. I think, well, yes. I also would say that it seems the market, you know more than me, Terry, but it seems that it seems to have been, well, especially in Sydney and Melbourne, seems to be in decline regardless of any of the changes. It's already come back. And as I said then, that I wouldn't want to be in a position where I bought, say, off the plan 5 years ago. I'm settling now, and I've got to sell that 1 month old property into a market where there's no longer depreciation on that 1 month old property, where there's another brand new shiny building next door. It'd be a pretty tough sale, I reckon, in this market at the moment. And so naturally, the price is going to come down, because as an investor, I'd say, well, hang on, why would I buy yours when next door I get $20,000 in year one alone deductions? With yours, I get $5,000. So the article that was written by the Sydney Morning Herald said there's at least a $50,000 immediate decrease on the value of the second-hand property. But what's happened, as you know, Terry, is the market's declined already. So how do you say, is it the 50K from the depreciation, or is it the 50K from the natural decline in the property market? I think it's pretty hard to work out that scenario.
So I suppose if investors have a bit of a hump in their mind about all these issues, one of the things I'd say to them is that the way to achieve wealth in property investment isn't to buy and sell anyway. It's to accumulate a portfolio. You buy good assets and you keep them. So the resale situation doesn't become an issue. If you bought a good asset, why would you sell it? Just keep it.
You're right. And I look back on my investing life, and I wish I never sold any property. That said, when I have sold, I have then upscaled, but I look back on, there's no asset I wish I ever sold, to be honest. So it's a good point.
Yes, the 20/20 hindsight's a great thing.
Yeah, that's right.
Okay. Look, we're coming up to the end of the hour. I think it's a natural place to close the webinar, Tyron.
Yep.
Thanks very much for your presentation.
Thank you. It's been fun.
Yeah,
thanks everyone for coming.
It's been entertaining and informative, and thank all the participation for tuning in and for your questions that you've sent in. Anybody wants to firstly take advantage of the special book offer, you drop an email to Tyron. The email address is on the screen there, tyron@washingtonbrown.com.au. If people want to follow up and maybe get a depreciation report, Tyron, send you an email as well. That's the $50 there. So it's $20 for the book, but if you send me an email and you want a report, I'm going to give a $50 discount on our normal fee for attending this webinar. So there's the email. You can either just get the book for $20, or if you need a report, I'm going to give you a $50 discount as well. So it's just we're just happy people and want to help. Good to hear. Okay, well, thank you, Tyron, for your presentation.
Thanks for inviting me, Terry. Thanks for inviting me.
That's all right. We'll do it again a little bit later in the year on related topics. Some of these issues. I mean, it's going to be a pretty momentous year for real estate in all sorts of ways, including the impact of an upcoming federal election. So
it'll be interesting next time when we're talking. We'll know who's won, and we'll know where that's at a bit. I think when the next scheduled one is. So that will be interesting.
Okay. All right. Thank you, Tyron. Thank you, participants, for tuning in. Everyone who's registered will get a copy of the webinar. So this is Terry Ryder from hotspotting.com.au signing off. Thanks again, and we'll do it again soon.
Thank you.